When we talk about has the SPAC market gotten ahead of itself, I think the answer is maybe. It feels like there's a lot of vehicles positioned for that IPO and go public resurgence. We're seeing some crypto companies, which are being some really well received, some still more favorably than the average transaction. We're seeing key themes like nuclear power. So there are definitely a couple of bright spots, but announcements certainly haven't kept up with the IPO euphoria.
Before we get started, I want to do a quick disclaimer that nothing we say here is investment advice. As well, nothing we say is marketing or advertising for RLH Capital or any of their funds. Everything is meant to be informative about the industry. Welcome to another edition of Other People's Money. I am joined today by Louis Camhi, CIO and founder of RLH Capital. Louis, thank you so much for being here today.
Thanks for having me.
Well, anyone who remembers you from your first appearance knows that we're probably going to be talking about SPACs today. RLH is a SPAC specialist fund, and things have been on fire in the SPAC issuance world. Maybe looking a little bit like the beginnings of another 2021 cycle. Do you think that's where we're headed?
You know what? I think it's too soon to say, but it's interesting for me. When I launched my fund, which was the fourth quarter of 2021, the SPAC market was deflating. We started the SPAC cynicism, and candidly, rightfully so. But this is really the first time where that embedded optionality in SPACs is really starting to stand out. And if you take a step back, this IPO SPAC boom really started in May 2024. And what happened back then was one, the number of SPACs outstanding declined significantly. And two, there's all this euphoria about a resurgent capital market, specifically the IPO market. And so, minus even a few deals recently, the IPO market's been shut for a long time. And you think about who the large asset owners are on the private equity and venture capital side, they need liquidity. And that liquidity is really going to come in one of two forms. They can either sell assets to other private equity firms or venture capital firms, or going public. And so that going public channel has been closed for a long time. And so I think the resurgence in SPAC IPO activity is really an indicator that these SPAC sponsors and bankers think that the IPO market's coming back.
Do you think that euphoria about the IPO market was it related to just the potential for a new presidential regime? What got everybody so bullish about IPOs? Because it really hasn't come to fruition aside for those, obvious exceptions.
Capital markets, broadly speaking, are cyclical. Whether you look at IPOs, in the IPO bucket, you can include direct listings and SPACs, or if you look at mergers and acquisitions. And so, naturally, when you go through periods of time where activity is subdued, you start expecting that, okay, this is the slow part of the cycle, it's going to accelerate. And then, with Trump winning the election, everyone thought back to, Trump's first term and, how exciting that was and how active that was for capital markets. And so I think some of that euphoria spilled over. And then, the first quarter was really dominated by, tariff tantrum. And there was no activity whatsoever. You had one big deal in CoreWeave get done. And, now we're starting to see a handful of these deals come. And so, I'm cautiously optimistic you'll see more. It seems like the market is less volatile and less reactionary to, some of the tariff commentary, which we can debate if that's good or bad. But, overall, lower volatility levels are better for capital markets activities. And so I'm cautiously optimistic that, we'll see the return of the IPO market. And, I think, a SPAC is a go public tool, and it's unlikely that you'll see SPACs work without IPOs and direct listings. And so I'm really waiting for, the three of them to accelerate. And again, if VIX stays low and if we get some interest rate cuts, I think all those things are, positive for activity.
Despite all the volatility that you highlighted in Q1 and the beginning of Q2, it was still relatively active, not quite as active as Q4 of last year. What has Q2 looked like?
Q2 has been very active for SPAC issuance. The market wants paper. You're starting to see new investors come to market both on the SPAC side and on the investor side. And look, I think if you're concerned about the market and you can put yourself into an investment like a SPAC where the downside is protected and you have some upside optionality, that's a pretty comfortable place to be when, you're concerned about geopolitics and the economy, et cetera. And so, as I've mentioned, I think we're starting to see some leading indicators moving in the right direction, but In April when the market came under some pressure, I can tell you it was really nice having a SPAC portfolio that wasn't really moving. And sure, the upside optionality wasn't really there. And again, the upside optionality hasn't been priced in really since early 21. And so that's not new. But if you're focused on downside protection, it's nice to have a vehicle with a trust floor.
I think we need to do a little bit of SPAC 101. Most people, when they think about SPACs, they think about the DeSPACs from
Sure.
2021, and the idea of downside protection sounds foreign. So maybe if we do SPAC
Yes,
101, what is a SPAC, the trust floor, and the DeSPAC, and maybe the difference there?
absolutely. So a SPAC is a publicly traded vehicle in which a sponsor, usually someone with M&A and deal expertise, raises a preset amount of money, let's say $200 million. That $200 million sits in a trust account and earns interest. Then the sponsor's job is to go find a merger target for the vehicle, which is basically a go public transaction because you're merging a company with a pool of cash. And during that time, while they're searching, the SPAC trades, and it usually trades to reflect how much money is in the trust account, which grows every day based on the interest rates, and whatever yield SPACs are trading at the prevailing time. And so if you own a SPAC at that stage, there is a minimal downside because you literally own US Treasuries and money market funds. Once that SPAC sponsor finds a deal, they announce the transaction and they start the SEC process. At the end of the SEC process, there's a shareholder vote. At that vote, there's two things that happen. One, as a shareholder, you vote if you want to approve or not the transaction. And the second thing you do is you say, do I want to keep my equity in the transaction, or do I want to get my money back plus interest? If you get your money back plus interest, you never actually take equity risk. And instead, what you've participated in is effectively a risk-free convertible bond, where you had the upside optionality that when the deal is announced, it trades up and people are excited. But if not, you can always get your money back plus interest. And so it's a very kind of unique structure. Now the nomenclature is important. So that's the SPAC phase. Once you get past the deal closing, it becomes a DSPAC. And now it no longer has this floor and the ability to redeem your money. It's just like any other equity security. And it could trade, SPACs are priced at 10. Once the deal closes, it could trade to 30 or it could trade to 2. It's just all about the fundamentals and trading of the pro forma company. And so one of those is kind of low risk, moderate reward, and the other is high risk, high potential reward. And so, where we tend to play is more on the former. We want to see good deals. We want to evaluate them. And generally speaking, we'll move on either before the shareholder vote or as part of that shareholder vote. And we won't take that equity volatility that happens subsequently.
Now, that all works if SPACs are trading below trust, but during periods of time when there's a lot of SPAC enthusiasm, they can trade above trust. Are we starting to see SPACs in that stage where they've yet to announce a target trading above the trust value?
There's certainly a handful of them. I would not say that that's the prevailing sentiment. When you look at some of these deals, you look at industries where the market's excited right now. The biggest one is, crypto. And so we've seen a couple of SPAC teams with crypto expertise, and they're trading at large premiums. But generally speaking, while we're seeing yields compress, we are still seeing SPACs trade below trust. The big question now is it's getting tighter with respect to financing costs. So a lot of investors in the space use leverage on their portfolios, and, you have a good problem and a bad problem. The good problem is if you have a levered portfolio and you just watch yields tighten by 100 basis points, you've made money. You now have to decide, am I comfortable taking a negative carry, meaning I'm earning less yield on the SPAC as compared to the financing that I'm paying, but I'm getting that upside optionality. Are you comfortable with that? And are you comfortable knowing that, if there's an unwind and you go back and the yields widen 1%, you're going to give that all back? So I can't comment on what others are doing. Our philosophy is generally we won't own a SPAC that's trading above trust on leverage. It just skews the risk reward a bit too much. Like, take the extreme example. If you own a SPAC and it goes from 10 to 12, that's great, but you really don't want to be sitting there if it goes back from 12 to 10. And so for us, if something goes from 10 to 12, we're probably selling it down to, 20 to 30% of its original position size. If we like the team and we like the deal, we still may want to stay on for the ride, but we're going to do it in with a greater focus on downside protection as opposed to maximizing upside. That's specific to us, right? There's different ways you can trade any instrument. There's plenty of investors that may see something trade to 12 and say, this is ready to break out and it's going to 20, and you should actually be buying more. And that's totally fine. Not our style, but there's, a lot of different ways to skin a cat and generate a return in this subsection of the industry.
Well, that brings me up to a question I've always had, which is when you're looking at these things, how deal specific is it, or can you be more quantitative and just saying if a SPAC trades from 10 to 12, it's more likely to trade to 15, and we're willing to take that risk and bet on those just because historically that's what's happened.
So I would break that down into two parts, or two sections. I think it's different after the deal is announced. So if you look at, there's some SPACs right now that are people really, really excited about. They're trading at, let's just say, between 5 and 20% above trust value. They haven't announced a deal yet. For someone like me, I find that really difficult to get comfortable with. But some people may, and in crypto where volatility is high and you do a good deal, like sure, I would tell you crypto has the highest likelihood of a SPAC going from 10 to 50, just by looking at, the volatility characteristics. So again, for me, difficult in the pre-deal phase. Once a deal is announced, I think the game totally changes because now you can bring a fundamental lens into play. And so if someone can source such a great deal that, trades to 12 and you're evaluating it and saying, okay, one, from a fundamental standpoint, I can see why this is worth 15 to 20. And two, these guys just created such a great deal that there's always a technical dynamic of the ARBs moving out and then the fundamental guys moving in those situations. And so you could look at it and say, hey, there's 20 million shares outstanding. It's traded, I'm making this up, obviously 17 million since the deal announced. So it's almost done turning out all the ARBs. And so once the ARBs are out, this thing can really move because there's no more kind of quote unquote forced selling. And so we may look at a situation like that and say, okay, with 1050 in trust, the stock's at, 12, I've got $1.50 of downside. I've got, if I think it could be worth 20, I've got, $8 of upside. That's a really interesting trade. Like I would keep something like that on the book. Would I supersize it? It's not really our mandate, but that's not a bad approach, right? If you're a more fundamental investor, it's pretty rare where you can look at an opportunity and say, I've got $8 of upside and $1.50 of downside in the 6-month window. I think those opportunities are really interesting. And it also speaks to, and we can talk more about this, the natural handoff that when the market is functioning should happen between the more arbitrage investors and the more fundamental investors.
Yeah, let's talk about that handoff. What does it look like? You said, 20 million outstanding in this theoretical example, 17 million turnover. I mean, are there people just trading around? Is it truly that clean that it's like number of shares outstanding once you see that trade, it's pretty much
It's
done?
not quite that clean because you've got algos and other dynamics, trading dynamics. But if you think about it, there's a lot of funds that are, their expertise is in arbitrage and not fundamental analysis. And so their job is simply, I like this SPAC management team. I'm going to buy the IPO at 10. I'm going to get the shares and maybe a fraction of a warrant or a right, depending on how it's structured. And, when the deal is announced, they're going to look at that and say, okay, this is hopefully a good deal. Now it's my time to move on. And so what is supposed to happen there when the market is functioning, let's say it's a tech deal, you want to have your tech fundamental investors looking at this deal and saying, yes, it's a good deal. And similar to an IPO where it's supposed to be priced at a 15% discount to fair value to get that pop and investor interest, that is how a good SPAC deal should be structured. And so in that environment, you would have, the fundamental tech investors come in, say, this deal is worth, again, let's make up a number and say 15. And so I'm happy to bid this up from 11 to 13. SPAC investors happy to sell all, if not most, and move on to the next opportunity. And so when that happens, one, if you're a SPAC investor, you're making more money, right? Because now you're selling at 11 to 13 in a shorter period of time. And two, you're getting validation of the product and the opportunity from the tech investor that has the fundamental skill set and expertise to, say that, yes, this was a good deal. And hopefully, as you see more of those over time, it adds credibility to, SPACs. SPACs right now, and again, we can talk about the history, but they burned a lot of their credibility in, the last 2 years of the SPAC bubble.
Yeah, that makes me wonder, who are the players in the SPAC market? Are they the same people we saw from the first time around? Chamath recently put out his poll, should I do a SPAC? I think it came out to be no, and he said, basically, F it. I'm gonna.
He made up his mind anyway.
Yeah,
Yeah.
he knew that the poll was. I think he made a joke that he was going to put the results of the poll in all of the disclosures about risk. So clearly he's taken his role very seriously since the last time around. Is it the same guys?
There's a lot of overlap, but if you take a step back, right, the SPAC market was a pretty discrete area of finance for up until I would say 2019. And then you had a couple of good deals and then everyone bought in, right? The barriers to entry for launching a SPAC are really low. It's a couple $1,000,000. You can pull that together. Now you have a SPAC. The problem was we got into this environment where everyone thought things only go up. And therefore, you had a lot of unqualified SPAC teams join the party. And in the process, they did bad deals or they ended up selling their SPAC for pennies on the dollars. And the new sponsors did bad deals because their cost basis was so low. And so, those dynamics really, just killed the SPAC reputation. And again, rightfully so. When you look at who it is now, you kind of have a whole hodgepodge of SPAC sponsors. But I think what's good about it is you just came off a cycle where a lot of SPAC sponsors lost money. And so if you're going into this, you know that it's not a free lunch. You know that you need to source a deal. You need to figure out a way to source capital. When you think about improvements to the SPAC dynamics, I would say, one, the investment banks are more commercial. So their fees have dropped considerably and they're more flexible on the back end. And two, the targets have gotten much more sophisticated. And so if you do a SPAC deal and the SPAC sponsor, gets a 20% promote, but raises no capital, when that comes down to the finish line, the targets are sophisticated enough to say, you raise no capital, you're going to forfeit, 70, 80% of that promote. And so that's really different than where we were, call it 4 or 5 years ago, when a deal could raise no capital, it would still close. The bankers would get their full pound of flesh. The sponsors would get their full pound of flesh. And it was really a value destructive transaction for the target. And so, seeing that kind of transition, I wouldn't say we're fully there where you'd want to see it, but it's moving in the right direction to, if the bankers are willing to play ball and cut their fees, if there's not a lot of capital raised and the sponsor is willing to cut their promote significantly or convert it to an earnout, well, now all of a sudden there's not a ton of dilutive capital.
Well, I think the argument for why those targets were perhaps happy with that is that it was value destructive, but at least it was value crystallizing on these companies where
Yeah, but
value was maybe
it's
more
it,
subjective.
it's crystallized on a piece of paper in the press release that says, your target's worth $1 billion. But then on day one, if you trade to, you know, 5 cents or 10
Yeah, sure.
cents, the market's, the market speaks loudest, right?
Yeah. So who are the targets right now, at least announced? And then we can talk about maybe some of the deals that have consummated.
So announcements have actually been pretty slow. So when we talk about has the SPAC market gotten ahead of itself, I think the answer is maybe. It feels like there's a lot of vehicles positioned for that IPO and go public resurgence. When you look at what's announced, there's still a whole hodgepodge from, we're seeing some crypto companies, which are being some really well received, some still more favorably than the average transaction. We're seeing key themes like nuclear power. There's 2 nuclear power transactions that have been announced. Those have been well received. And there's a handful of other deals. There's a SPAC called Colombier. They've announced a deal with a gun marketplace, online marketplace, and that stock's trading at 15 pre-close. So there are definitely a couple of bright spots, but announcements certainly haven't kept up with the IPO euphoria.
So on the crypto side, are these crypto companies or are these companies that are going to try and do the crypto treasury similar to MicroStrategy? When you say crypto
So
company, what are we talking about here?
so right now it's more of the latter. There's been 3 such transactions. CEP was a Cantor Fitzgerald deal. That one's trading really well. Last I checked, it was around $30. So, you're up significantly from 10. You saw a SPAC called Columbus Circle partner up with Anthony Pompliano. And so they launched a Bitcoin treasury strategy. And then you saw a transaction announced by the MBAV SPAC, which was taken over by Chin Chu and his partners. They announced a deal where they're basically creating a treasury of the largest cryptos and some crypto VC. They didn't market it this way, but that one's interesting to me. It feels almost like the one-stop shop equity security if you want crypto exposure. And so, those are all trading pretty well, relatively speaking. But what we haven't seen yet, and what I anticipate seeing in the coming months is, an actual crypto operating business. I think, the market's pretty fatigued of the digital treasuries in the SPAC wrapper. I think those opportunities still exist in the pipe wrapper, and we've actually participated in some of those and happy to speak to it. But, it's clear based on where some of these pre-deal SPACs are trading with the crypto sponsor teams that there is an appetite for some of these, crypto operating companies if they're, of course, if they're the right businesses and the right valuation. But I do think that those will be pretty well received.
What are the rumored businesses that, SPAC investors might be interested in?
I can't give you specific names. I think, for a while, like Tether was out there and, I'm not smart enough to tell you like if that's real or not. And I try not to go down the rumor mill. Like there's only so many hours in a day. But look, I can tell you like anything else, right? And I'm not a crypto guy, but if you see a business that's a public company scale and has the right governance structure and is profitable or close to it, I think that'll be well received. I think what you don't want to give investors flashbacks of is here's our business and we're going to generate revenue in, I guess back then it was 2030. So now you would say 2035. I think those are the opportunities that you want to exist where it's really more of an idea. I think it has to be a more mature operation.
Okay. Now these crypto pipes you were talking about, what have you been participating in and why? As somebody who's not a crypto guy.
So not a crypto guy, but we look at a lot of arbitrage and kind of relative value. And look, I think people woke up, a few months ago looking at MicroStrategies and saying, well, this is amazing. Like it trades at 1.9x NAV or, 2, or, I guess different people have their different analyses. And so, can that be duplicated? Can it be duplicated for other companies with Bitcoin or other cryptocurrencies? And, my kind of observation, and you could tell me I'm totally wrong about this, but I view these trades more as cost of capital arbitrage than anything else. And so if you look at what MicroStrategies has been able to do, they're able to go out there and raise a convertible bond, way out of the money. And that's how they can finance some of their Bitcoin purchases. You or me, we can't do that. Right. And so if you think about that, they have that advantage and we don't. So how do you price in that advantage? Well, qualitatively, if we were two businesses and one of us had access to that capital and one didn't, the one with access would trade at a higher price. And the way that manifests itself in the public markets for these businesses is they trade at a premium to NAV. I struggle a bit with quantifying that, but I've kind of convinced myself that qualitatively, like that's a reasonable framework. And so I actually, partnered up with a firm called GSR, and we were able to create a Solana treasury company called Upexi. And so we met with the Upexi team, and they've got a great management team, and they were interested in crypto. And we were able to, help raise them $100 million to go out in there and buy Solana. And, their stock, I think we priced the offering at 228. And now after the unlock, I think it's trading somewhere in the threes. I haven't looked at it in a couple of days. And so you can kind of see this trade resonating. And when you compare that to a SPAC, when we did the Upexi transaction, you had liquidity if you wanted it within 2 months. There was a similar transaction by a company called SBET, and they did an Ethereum strategy, and were able to provide liquidity in 2 weeks. And so I think for investors, this whole idea resonates that, okay, creating these treasury companies and getting quick liquidity, that makes a lot of sense. But part of it that's a little harder to break down from a market health standpoint is these have all had violent squeezes up. So, Upexi priced at 228, I think it hit a high of 20. SBET priced at 6 and change, and, it hit a high, maybe 50, 60, 70. And so I don't think it's super healthy. And we see this in SPACs too, when you have these low float squeezes, because inevitably you're playing a game of musical chairs and can you sell before all the liquidity comes? But it's pretty clear that for now, this theme is resonating that if a company has access to lower cost financing, they should trade at a premium, and therefore there are opportunities to participate in pipes. Again, this is for me, this is not a core strategy for the fund. So we size these positions pretty small. So we get to have the high class problem of we made money, we wish we did more, but it's one thing to do it at a 1 to 2% position when it's non-core. It'd be different to do it at a 5 to 10. And so, we're just excited for this opportunity. And, we have like an SPV set up to do them as well, because again, we tell our investors that the core focus of the main fund is SPACs, and that is 100% true. we have participated in some of the SPAC pipes, just given that that's more core. So, you know, the Columbus Circle deal I mentioned earlier, as well as the MBAV transaction announced today, we were we were pipe participants.
When these squeezes occur, is it truly just because of the low float, or are there arbs who, unlike you, have not been able to wrap their heads around this framework of like, well, it's worth something. I can't quantify what this cost of capital advantage is, but it's worth something. Are they people who just can't come to that conclusion who are getting squeezed and are short?
I don't think anyone's really short these. I mean, if you look at like a Upexi or an SBET and, there's a handful more in market right now, they generally target companies that are, sub $30 million in market cap. And so they tend not to have a short interest, but rather the floats themselves are so small that, if you go in there and buy, 25,000 shares and the next guy goes and buys 25,000 shares, you can move the stock very quickly. The problem, or I should say problem, but the challenge is, that after a certain number of weeks, and there is some uncertainty over how many, that a lot of supply is coming. So like in the Upexi deal, for instance, the shares outstanding were about 1.5 million. And then in this transaction, we raised 45 million shares, give or take. And so sure, not everyone's going to sell, but if half the people sell, you've got 20 some odd million shares hitting your float of 1.5. And that initial float expansion from 1.5 to 47 is pretty painful. And so when we've had these conversations with the companies themselves, we've told them the good news is, look, it's going to be painful, but it's one and done. Like, you are not going to be expanding your float 30x in a single transaction, most likely, ever again. And so, I always call it monopoly money when you see it trade up 5, 6, 7, 8, 9, 10 times. But eventually you kind of, you get your shares registered, you have a normalized float, and now you can rebase and execute on your business plan, which for these companies should be raising capital and deploying it into their selected cryptocurrency. This happened like back in the SPAC bubble. There was a SPAC called like QuantumScape, still a public company. And I remember, a bunch of people invested in their pipe at 10, and I think it hit like 150. And I think the most challenging thing for a manager is it hit 150 crossing December 31st. And so now you have this fun question of, how do I mark this for year end? And I think the right answer is, can you side pocket it so you don't have to even deal with it, and you'll pay yourself your carry when it monetizes. But, you don't want to sit there and like mark this thing up and you and your investors feel great. And then the next year rolls through and all of a sudden you have this big markdown. And so, it's a high class problem, but, these are not uncommon. You still see them to this day. There was a SPAC recently that closed, or a handful of SPACs that close low flow, they squeeze. I generally stay away from those. I'm not smart enough to trade them right. And I'm sure there are guys out there that are finding a lot of opportunities if they can time it right on both the long and short side.
QuantumScape, it's bringing me back. That was one of the it was an activist short target for a while there. Also,
Yep.
lots of fun. Oh, these are great. These are great trading names.
Yes.
But what about the other themes? You mentioned nuclear power, guns. Um, Obviously, Trump had his SPAC before with Truth Social. How many of these SPACs are sort of leaning that way into these themes that are related to the administration, whether they're policy related, like there's been some discussion of nuclear getting some love from the Trump administration, or just ideologically aligned in the form of guns?
Not too many yet, but again, you've got, about 100 SPACs right now searching for a target. So it wouldn't surprise me if, SPACs were starting to prioritize, opportunities like what you just described. Like, why wouldn't you? It's, a lot of the SPAC market, and, and there's about 145, just to correct that number, SPACs seeking right now. A lot of the SPAC market has historically been kind of pattern recognition. What's in vogue right now? And to be fair, that's what got it in trouble the last time around. People saw the Nikola transaction, just to give you another name from the past, trade up to $80. And all of a sudden, everyone's calling their banker and saying, hey, like, Nikola traded to $80, like, find me an electric vehicle deal. And then you did a whole lot of electric vehicle deals, and they all went the same way when the Fed started raising rates. And so it wouldn't surprise me if you see some of that kind of monkey see, monkey do, to whether it's nuclear, whether it's, more pro-Trump policies. I mean, if you look at the crypto deal announced today, They're mimicking like the Trump crypto portfolio. And so you can put it in that bucket as well. But people are going to look at these and say, okay, I know I can get the best economics if I find a good deal and I can keep most of the money in trust. How do I optimize that right now? Well, it's key themes like, the ones you just named. You can throw AI in there. Um, and so, I think you'll just see a lot of, it's too soon to even come up with the copycat playbook because, as I mentioned, we're really only seeing 4 deals trading above trust. But I think, what you see in the IPO market is going to then resonate into the SPAC market. I've always said, the way the SPAC market becomes most effective is you have a big player in a space, the number one player, they're going to do their IPO with Goldman and Morgan and JP Morgan, all the big boys. And the number 3 player in the space isn't going to be able to command the attention of those underwriters. And so they're going to partner up with a good sponsor and be able to ride the coattails of that leading, number 1 market share company in their space. And so because the IPO market really hasn't opened yet, it's hard to do the analysis on what's really in vogue. And we only really have, 4 or 5 data points within SPACs themselves. So I think the next time we chat in a couple months, we'll be able to go, more in detail on that topic.
Okay. So who are the core we've also rans?
Core Scientific, right, which Corey was just buying, that was a SPAC. I mean, it had to go bankrupt first, but, I wouldn't be surprised if you saw some more of that. And, we've actually, what's also interesting is there's a handful of targets that were slated to merge with SPACs that are now pursuing IPOs. And so we were actually involved in one. We were lenders to them during their SPAC process called Arrow. And Arrow got down to, the 25th hour. They're ready to close, didn't raise enough money, and just thought, the management team there thought, we think we can do a traditional IPO. It's their core business is military drones. So talking about thematic, that's pretty on theme right now. And so, they were originally going to close last August. They instead pursued an IPO process, ended up raising 75 some odd million dollars last month in an IPO. And so we were, proud to kind of be lenders to them. And, I joke around, I think we made them a 4-month loan that turned into a 16-month loan, but it worked out well for everyone. So
Are you doing more of these loans these days?
we're looking at a lot. Our key criteria is, one, we want the loan to be to the target business and not to the SPAC because the SPAC itself doesn't have assets. And 2, we want to underwrite the business to understand, can you support this debt without a go public transaction? And then we'll go further down and say, okay, the 2 biggest dynamics that stop a deal from getting done are the audit and then the minimum cash. And so understanding that dynamic, because what we don't want to happen, and again, Arrow was fine because we kind of had this ongoing dialogue the whole way, but we don't want to happen when we're providing bridge financing and it turns into permanent financing. That's just not the business work. So we're looking at a lot of stuff. Candidly, with some of these pipes that are shorter in nature, it's harder to get overly constructive, but that flip flops, and we are currently looking at underwriting for lending opportunities.
Well, I guess if there aren't announced targets, there's nothing really, you can't lend to the business, right?
Yes, there's definitely been fewer things to look at, and we've got a couple of deals that we made loans to over the past few months that should be closing in the coming months, and so that's going to free up a lot of capacity as well. The way we kind of, again, this is an RLH specific, but we kind of construct the fund so that 85% is in, publicly traded SPACs. So you have liquidity and downside protection. And the other 15% of the fund is going to be in the higher risk, whether it's bridge loans or non-redemption agreements or pipes. And so that way, and we, by the way, we've had some feedback and we created an SPV because some of our investors only wanted exposure to, let's call it the juicier opportunities. I call it, or I guess depending on the day with some of the volatility, I call it the NVIDIAification of the market. Like low downside, that's fine. I don't care. Like show me your best returning ideas. But so as we see some of those mature and realize we'll definitely be well positioned in the next 2-3 months to put out a bunch more capital.
Well, you've been active on LinkedIn, updating people about what you all are doing, and recently you put an update out talking about taking on some warrants onto the book. So what's going on in the SPAC warrant space, and what has you stepping back in to take on this warrant exposure?
The warrants for us remain a really small percentage of the portfolio. We got into some trouble, my mistake back in 2022, and we just had too much warrants exposure. And when I think about creating that upside exposure, I think I can do a better and more unique job of doing that through some of these bridge loans than through the warrants. That being said, we are opportunistic, and so we will look at warrant opportunities. And so I would break down, the one thing, and I actually didn't put this on LinkedIn, so I'll give this to you here as a first. But a lot of warrants have a change of control provision built into them. It gets skipped over by traditional merger arb guys because they're smaller. But basically, a standard warrant, just to give the 101, at the time of the SPAC IPO, it's usually a unit, and it's one share of common stock and a fraction of a warrant. Sometimes there could be rights involved instead of warrants, but let's just focus on the warrant for now. And generally speaking, each warrant has a 5-year life from the time the deal closes and an 11.50 strike price. And so you may assume that, if 3 years after the deal, there's an acquisition for $5, the warrants expire worthless. Sometimes yes, but sometimes there's a change of control provision built into the warrant agreement. And that change of control provision basically says at deal closing, you run the Black-Scholes valuation on the warrant, and that is a consideration that you have to be received. And so a lot of times what we'll see is there could be warrants that were dead and not trading, trading at 5 cents, and all of a sudden a deal gets announced and there's some liquidity, and the guy who just owns these is happy to clean them up and is going to sell them for 20 cents, and he just 4x his money. But you run this Black-Scholes analysis and you may say like, well, they're actually worth 60 cents. And so we'll step into a lot of those situations. Some of the more recent ones was a company called Satisfy, which just closed its transaction earlier in July, where we were able to build a position in the 30s and exit in the high 65 range, high 60s, low 70s. Another one, there's been, I want to say 5 or so. Another bigger one for us was Money Lion. So Money Lion was particularly interesting because if you participated in their warrants, you received 1, cash, and then 2, also some CVRs that they issued as part of their deal. And so, I honestly wasn't expecting it. I thought the letter of the agreement was a little ambiguous, but it worked out well because we got these CVRs and they traded up nicely from the time that they were issued to us to when we could trade them. So it's just another kind of niche strategy within SPACs. What I was alluding to more in my post, though, was when you look at these crypto deals specifically, crypto is going to be a higher volatility asset. And you can look at something like, MicroStrategies. If you look at their options, their longer dated options, the implied volatility is 70%. And so if you start playing around with, a Black-Scholes valuation and say, hey, at $10 and 70% with a 5-year life, what are the warrants worth? You start getting some numbers that are really interesting. And then sure, you need to haircut them for, there's always risk a deal doesn't close. And, so if you think about that progression as each deal milestone is hit, they should trade up. But, in some of those cases, it just feels like the warrants may be misvalued. And again, I think it's different than when you look at a more traditional fundamental opportunity when you're sitting there saying, what is this worth? I have my view, the market may have a different view. With these crypto treasuries, you can look at it and oversimplify and say, well, and again, what I'm about to say could completely change, but right now these all are trading at, 1.2 to 2.0 NAV. I know what NAV is, so let me kind of sensitize what the common could be worth and then layer on this Bitcoin with a 70% volatility. Like where would that trade? And so I think that's particularly interesting of the 2 crypto deals that have announced that have warrants, so MBAV and CCCM.
Okay, so basically it's more that the vol is cheap than the
Exactly.
warrants themselves are cheap from a, like a delta perspective.
Exactly.
What have I missed in the opportunity set?
You haven't missed a lot. Right now it feels like, every day I get to my terminal in the morning and I'm like, is today the day we see 3 big deals? And are those deals going to be well received or are those deals going to be hated? And so, we saw Churchill announce a deal recently. Churchill is a tier 1 sponsor. Everyone follows them. And candidly, I thought their deal was a little underwhelming, and not to kind of, criticize the company itself, but it was a transaction that was originally announced in 2021. And so don't get me wrong, for all I know, and I'm not in the weeds here, but this company could be completely different, right? Like 4 years was a long time, but seeing them, again, someone you view as tier 1, bring back something that was announced 4 years ago, the headline isn't great. And again, hopefully that's all it is. And that, beneath the headline, this company has matured and right-sized its operations and grown, et cetera, et cetera. It could be a great deal. And, any company that's the same, 4 years later has been dead for 4 years. But that's what I'm really waiting for. It's a patience game. We're happy to look at these IPOs and partner with these management teams and hope that they can achieve kind of strong results. But it's getting to the point now where, we've got 145 SPACs seeking a target. You want to start seeing good targets. And again, I think that you can't penalize SPACs in a vacuum for that. It has to kind of flow with the entirety of the IPO market.
Okay. I want to switch a little bit to talking about RLH. So you mentioned these SPVs. That's new. I think the last time we talked, you weren't really doing that. Did that come from existing LPs, or did you have interest from outside of your investor base?
I would say 80% of the LPs overlap. So long story short, we put out our quarterly letter and we spoke about these lending opportunities. And, these lending opportunities can be lucrative when they work out. Candidly, there is a lot of labor behind the scenes. One of the questions that I was always asked when I was on the fundamental side was, why does this opportunity exist? And after working on a couple of these, they exist because they're small sums of money and they're really difficult. And if you're a larger lender, you'd much rather write a $25 or $50 million check than we write $1 to $3 million checks. And so we talked through the opportunity in our letter, and a lot of the feedback we got back was, this is really interesting. Why are you capping it at 10% of the fund? And I said, the fund is a risk averse vehicle. And so if in a hypothetical situation where the 15% at risk stuff, let's call it, all went to zero, which would be really weird because they're all different investments, but let's just take some, 5 standard deviation event, then the 85% that's in the SPAC R book is going to cover those losses and you end up close to break even. And so that makes it really easy for me to sleep in. And their feedback was, okay, I get that, but this is really interesting. And you're syndicating those loans away. Why aren't you just creating another vehicle for existing LPs to participate? And so, we raised the first SPV back in November. It invested in 3 deals alongside the fund. The first of which, we'll hopefully realize later this summer. And, assuming that investors are pleased with those results, we'll create another vehicle. Maybe this first vehicle was a single draw. So maybe we'll create kind of something with, a drawdown vehicle to last for a year and, pursue kind of these opportunities.
So previously, you would, let's say the borrower needed 5 million, you'd do 1 million or 2 million, and then you'd find somebody else to cover the rest of the 5. In this case, you're
Basically,
going to
yes.
the LPs. Okay, makes sense.
And so, it just, the LPs were like, we should get, and rightfully so, like, you're doing the work anyway to underwrite these. Why wouldn't you give us first crack? And it's like, nope, you're totally right. And so, that led to the first SPV. Then we had like another SPV form for some of these other pipe opportunities that are a little different. And so, my goal is simply, if I'm, if I'm touching something vis-a-vis a SPAC, I should be giving my investors the opportunity to, to get that exposure should they want.
Okay. Anything else new?
We're hitting the conference scene a little bit more. Something we hadn't done in the past was marketing. This year we started by going to the Uncorrelated conference. We were one of the sponsors for their LA event. We'll be a sponsor again at their Miami event in January. So if anyone's going to be in South Florida in January and wants to get together, I'm more than happy to do that. And really just try to explain to investors SPAC strategies. The one thing that hasn't changed is the media doesn't help when it comes to SPACs. And, there were some interviews with on CNBC recently, and all they wanted to do was attack the SPAC promote. But, they never attack private equity promote, right? Promote should be earned if you generate returns for everyone. And if you don't generate returns, it shouldn't be earned. And hopefully you see more kind of structures that have the incentives in the right place. But besides that, at the management company level, it's kind of the same. We come in every day, try to figure out ways to make money with low risk and try to figure out better ways to market and communicate.
Yeah. How were the conferences going for you? It's something that, a lot of everybody's like, I don't know whether it's worth it to sponsor these conferences because you go and you talk to the salespeople about attending, and naturally they always say, would you be interested in doing this sponsor? And nobody knows whether the money is worth it. So what's been your experience with Uncorrelated?
So I echo that view. The uncorrelated events have been great. I've met a lot of interesting people, everything from potential investors to service providers. The actual guys running the conference are fantastic. But the hard thing to figure out, right? Like in this business, you don't show up, meet with someone, and then they sign your sub. And so you're basically meeting with them to get them on your distribution to hopefully convert them over time. And so my biggest challenge as someone super quantitative is how do you figure out the ROI on that conference, right? You know what your expenses are, your cost of the conference, your travel, accommodations, whatever, that's easy. But, when I add 30 people to my distribution, you know, how do I know if one's going to convert, if two's going to convert, if none will convert? And so that's really the challenge. Um, I've justified it to myself saying, I've done no marketing before and I focus on a product that's largely misunderstood. And so I owe it to myself and the fund to get out there and try it. And at some point, I don't know what that point is, but at some point I'll have to say, this is working. Maybe I need to spend more, or this isn't working. And maybe it's time to, pull the spend.
Okay.
I mean, I won't lie. They do a great job of hosting these in nice places. So Puerto Rico, Beverly Hills, Miami. When you're in New York in January and someone's calling you to Miami, it's hard to say no.
Yeah, that is always nice. Well, maybe we'll be down in January. I think uncorrelated is around that's like the whole Miami alts week, hedge fund week.
So uncorrelated is at the end of January. This year, iConnections is the end of February. So it's normally, and I think the genesis of iConnect or of uncorrelated was to basically be next door to iConnections and kind of piggyback a little bit. So it's we'll definitely be at uncorrelated. It's TBD if we'll be at iConnections. I'll probably be in the area. Just don't know if I'll be attending. iConnections is a little more expensive. So
Yeah, well, I've heard a lot of people just go to iConnections, like, because everybody's there. It's a nexus where
yes,
it's like you don't go to iConnections because you're going to meet 20 new people and they're all gonna sign your sub docs in a couple of months. It's like there are 20 people who are already on your distribution list who you wanna go meet in person, press the flesh, and you know they're gonna be at iConnections, so let's go down there
exactly.
because instead of having to fly all around the country to meet all these people, they're all gonna be there.
That's exactly right. I mean, last year when I was there, I met in person for the first time the guy who handles all of my outsourced operations. Because I launched a fund in 21, it was still COVID lockdown, plenty of Zooms and calls, but never met in person. And all of a sudden, it's like I know you from Zoom, and it's the human connection part is always nice.
All right. Well, Louis, thank you so much for coming back on, giving us this update about the SPAC market, the way things are moving. We'll probably have you back on soon.
Would love that. Thanks, Max. Appreciate it.
Thank you.